I'll briefly just introduce, the motivation behind thinking, conceptualizing, and bringing this report out. As I mentioned, we've kind of conceptualized and brought together this report in partnership with Equifax. Again, everyone who is listening to this conversation, who's interested in this track on microenterprise financing, are all well aware of the challenges that this micro enterprise segment faces in growing. And one of the key constraints that has been cited is apart from, of course, capacity constraints, technical know-how, market linkages, and so on, access to affordable, formal financing is constraint that particularly the financial sector participants and the inclusive finance sector participants are interested in. Also with this recent revision in the definition and classification of MSME, those of us, Axis and several others who are focused on the micro segment are probably a little worried of how this impacts the really small micro enterprises. So this, I think, the motivation behind this report is to look at the missing middle that we have been talking about for several years now. So the microfinance industry caters to borrowers that take loans from for up to 50,000 rupees, and some individual loans also up to rupees 1 lakh. But the segment of rupees 1 lakh to 5 and then also up to 20 lakhs is the segment that we thought there isn't enough documentation on. And then we approached the Equifax team to see if there is a possibility to get some insights, data on this segment, so that we can start looking at some trends on how the loans in this segment are behaving, and how are which financial institutions are lending to what kind of segments within the enterprises in this missing middle segment. So therefore, we are releasing this report today. I should mention to everyone that this report is already available in the Summit Resource Center as part of this virtual platform. And I think we've put up the wrong report. I'm sorry. I'll request the tech team to put the right one. This is, of course, the Inclusive Finance India report that we released at the inaugural yesterday. Meanwhile, as I said, we wanted to bring this out, and this is the beginning, because we imagine and we hope that this partnership that we have with Equifax, we will make this hopefully an annual edition, and we will therefore then be able to actually generate a trend and be able to do a more nuanced analysis based on year-on-year data going forward. Also, since the data in this report is up till March 2020, most of the data, so the impact of the pandemic probably is not visible, and that also will become evident when we hopefully bring this report out in 2021 again using March 21 data. I must put on record our deep appreciation and gratitude to Mr. K.M. Nanaya for agreeing to our request for this partnership, and to his wonderful team for providing, the data that is the core basis of this report. Also, I would like to mention a big thanks to Harsh Srivastava, who very enthusiastically agreed to our request to help with bringing this together. and has done so wonderfully. He has coordinated a lot with the Equifax team and helped us bring this report together. He will present the key findings of this report so the audience can benefit from the observations, in addition to, of course, reading it at leisure. So, I mean, limitations of a virtual release that we would otherwise would have had liked to be on stage in person, unwrapping the book and doing a photo op, but we'll have to be content with this. So moving on, I would now request Mr. Harsh Srivastava to share with us the key findings of this report and let us know the current state of micro enterprise financing in the segment of 1 lakh to 20 lakh based on Equifax's data. Over to you.
Thank you, Radhika. Appreciate all of you and Mr. Nanaya. I will just start sharing my screen and then we will, I will talk about the report so that you can, of course, you can read the report, but let me start sharing this screen. Just a moment, please. Can you all see this?
Yes.
Okay, great. Thank you. So this is a unique report that is being prepared for the first time. We've all talked about the challenges that small businesses face in India, but we never had the data about what they are and what do they do and how do they borrow and most importantly, how do they repay? Because that is also a critical part of inclusive finance. So I've prepared this report really working very hard with the team of Access and as well as Equifax. And we've put together something which is for the first time in India, I think that we have this kind of data. And I'd like to share some of the highlights. This is, as I said, a snapshot of March 31st, as Radhika was saying. Subsequent years, we will have a trend. But this report talks briefly about where we are as of this date. So who are micro entrepreneurs? Many of you know that there are, by government definition, there is something called MSME, micro, small and medium entrepreneurs. And there's a whole ministry about it. Last year, there was a committee that I was part of, and we had recommended changes in the definition of MSME. So now it is entirely, and the government has accepted those definition changes. It said that turnover is the criteria. Micro entrepreneurs are those who have a turnover of less than 5 crores. And the way this report is based is that it is identified by 2 streams of data from Equifax. One, which are commercial loans, explicitly written in the loan what it is for. And the second is retail loans, which are for business purposes. Retail loans are taken by individuals, but are for, when they take the loan, their purpose is for business. Because there are many, and commercial loans are for by entities, whether a partnership, whether a company, whether a Hindu undivided family, or even a sole proprietorship, but taken in the per entity's name, not the individual's name. This report doesn't cover microfinance loans, or it doesn't cover loans for durables, because that is not in this category. So there are 2 broad streams of data that cover this, commercial loans and retail business loans. And across both categories, micro entrepreneurs had taken 4.7 crores low number of loans, and with an amount of 16.3 lakh crore loans as outstanding on March 31st. And this is the principal outstanding. The reason we picked 20 lakh as the upper limit is that we felt that anyone who is a micro entrepreneur with a loan with a business size up to 5 crores has probably taken a loan of up to 20 lakhs for his business or her business. And therefore, we fixed the number of 20 lakh as the from which all our data will be. We could have picked a larger number, but our best guess is that anyone who has a business of 2 or 3 or 4 crores will have taken a loan of 10, 15, 20 lakhs. And this is the snapshot that we have. So as you can see, this is a very large number of total loans given by different types of institutions for business purposes. And this is where we stand. And move to the next slide. This is what I believe is that there is a missing middle, which we've all talked about. And these are the smallest category of loans which are less than 5 lakh. And that is really, of course, 74% of total number of loans. But in my opinion, it is the next category of loans, which in the context of micro entrepreneurs, which are loans from, 50,000, 1 lakh, 5 lakh, 10 lakh, 15 lakh and 20 lakh, are the really where we should be focusing on. That is in the loan range of 5 to 10 lakhs. And this is only 12% of the loans. And my estimate is that this middle category among the micro entrepreneur category probably has business size of 50 lakh to 1.5 crores. That's why they've taken loans of 5 lakh to 10 lakh. And this is where we need the most policy support, because this is the middle or the missing middle who are resilient. If you have a business of 60 lakh, 70 lakh, 1 crore, you've already probably paying GST, you're hiring some staff. It's not just you, it's probably 3 or 4 other persons. So if we focus on this missing middle of businesses in the range whose turnovers are between 50 lakh to 1.5 crores, and have taken loans as a proxy from 5 to 10 lakh, that is where government and other support should be taken, because this is where we know very little about. Someone who's taken a loan of 2 lakhs and 3 lakhs or 50,000, maybe a retail business individual. He is running a small business, he's doing something. But the next category is where we should focus on. And this is where the data tells us that it was only 12% of all loans. Now, who lends? This is a very interesting data that came out from the report, that the PSU banks are the biggest lenders, which is fairly obvious because they have the largest branch network. And they have lent 69% of the loans, number of loans, and 62% of the loans by value. The private banks are second with the total number of loans that, remember I talked about 4.7 crores worth of loans in an earlier slide, that private banks have 13.6%, but by value, their loans are 19%. So their average ticket size is highest. Then there are NBFCs, and NBFCs, reach out to many, individuals. They have an interest reach. There is a very interesting category that we know very little about, are regional rural banks. And they are, at 4.7%, but their average ticket size is very small. And there are other institutions are, which are in different categories, are only by volume very few, but by value large. What was to me very surprising was that small finance banks, whose job is to be lending entirely to, small businesses, are only 1% by volume and 0.6% by value. They are in the commercial loan category. They are not separately counted as of now. They're lumped together in the other institutions group. Going forward, I think they will be counted separately. So there may be more data about their commercial loans. As of now, the small finance banks are only the retail business loans. But this sort of shows the spread of lenders, and the how public sector banks are, of course, the biggest, and there are other institutions. So to me, the surprise were two parts. One was that the data showed that RRBs, which we didn't know enough about, but they obviously have a reach, and small finance banks, who I hope in future will have an increasingly larger share, not just by volume, but also by value. And their commercial loans will also be separately counted and tracked. And that allows more data about how these small finance banks are doing. What do the borrowers do? What are their category? So this is a very interesting breakup also, which is across agriculture, manufacturing, and services. And I'm using only commercial loans because that is where I could get the breakup of. We will also later on get the breakup of retail business loans. And as I said, commercial loans are 79% by volume and 88% by value. So in that, the share of agriculture is only 4% by value and 9% by volume. Services are much bigger, 85% by the number of loans and 72% by value of loan. Manufacturing is very high average ticket size, which makes sense because in manufacturing, you have to be investing in equipment. And that is why you take an average loan is much larger. And agriculture's share is, as GDP data that I'm giving also, So what, from a policy point of view, it seems to me that disproportionately fewer businesses are there in agriculture, micro entrepreneurs who are starting businesses. And that is something that is one of the points that this data has shown up. Services is probably, of course, the easiest to start a business in urban areas or in semi-urban areas. And we'll come to that as well as a breakup of where these loans are. Manufacturing, I guess, at 24% of the value of loans is close to the contribution of manufacturing to GDP. But where it is less, where it should be, where it could be more, if there was enough support and enough training, enough capacity building, enough market linkages that Radhika talked about increasing the size of agricultural businesses for micro entrepreneurs. And services will, of course, be so large, and going forward also, of course, it will remain its largest share. So this is what was a surprise from the data, especially when you compare it to our GDP contribution. And then where do they stay? This is also, and in this, again, I'm sort of combining both the commercial loans and the retail business loans. That, to me, the surprise really was that semi-urban areas, however, they're defined, have 36% of the number of loans, although the average size is, smaller. And there again, of course, micro entrepreneurs or in cities, in urban areas, are taking bigger loans at 5 lakh on average. And in this, I guess almost all the manufacturing loans would be in urban areas or in semi-urban areas, which is why it is pushed up. But again, we can see that rural sector has smaller businesses and fewer loans, but the number in terms of number of loans is not too bad. 22% are in rural areas, 36% in semi-urban areas. So again, the sort of policy focus, if India needs to promote prosperity and spread its prosperity, is to look at semi-urban areas where there's already a large number of businesses. That's why we have 36% of all loans there. What more can be done to create more conditions for micro entrepreneurs to start and to grow their businesses in semi-urban and, of course, in rural areas? So this is another useful nugget that this report has based on the data that Equifax has put out. And it brings us to many, many such policy recommendations that all of you who are in the audience can look at, and even Access can work on later on. So this is, if you read the report, the best and most interesting use is the categorization of who are the borrowers across states, across both commercial loans and retail business loans. We have detailed data state by state. And to me, surprisingly, Andhra Pradesh, which is relatively a smaller state, had very large number of people who had started businesses. Maharashtra, of course, was first. And Andhra Pradesh is ahead of Tamil Nadu and Karnataka. And very interestingly to me, West Bengal had more people taking loans than Gujarat. And in commercial loans, Dadra, Nagar Haveli, and Delhi, have sort of large average size of loans in each of these states is very high. And possibly in Dadra and Nagar Haveli, which is a very small state, it could be because there are many manufacturing units located there. And Delhi, being a very prosperous state with a high per capita income and with many manufacturing units across all the many industrial estates, has a very large ticket size of loans. And what is, of course, expected but still very dismal is that northeastern states have very low average ticket size of loans. And if you count the retail business loans, is that Chandigarh has the highest average ticket size of retail business loans, and Assam has the lowest. And that was also surprising, among big states. Of course, there are, later on you will see in the data that Assam has many loan accounts. That is, many people are taking loans, or maybe one person is taking multiple loans. The average size is very small. And Chandigarh seems to be a hub of entrepreneurial activity because individuals, that is retail, are taking loans, larger size loans for businesses. Now, of course, Chandigarh is a very small place, but what would be interesting to see is what did Chandigarh do right? What kind of policy and infrastructure inputs that Chandigarh did that can be replicated in other cities, and in the other large cities, who can therefore ensure that if you were to do a city by city track of loans, this data is only state by state, you could probably see that other cities of the size of Chandigarh, other tier 2 metros, as they say, also were able to take so many large number of retail business loans. You must really, I urge all the readers to go through the state by state data that is available, that I put out from the report, and look at it, because that shows a fascinating part that has never been done before. I don't think any other report looking at micro entrepreneur financing has got the state by state level data, and it shows where we are, and each state can take its own, and I'm sure there can be state level conclaves and state level workshops organized by not just Access but by others to understand what is happening in each state. And then I did an interesting exercise. I tried to compare the average loan size to the state per capita income. And there I got a very fascinating and unexpected figure that Uttar Pradesh, compared to its per capita income, is taking far larger average loan size. Because you would like to think that richer states will take bigger loans and poorer states will take smaller loans, the average size of loan. But Uttar Pradesh is taking, so there's something that, Uttar Pradesh is taking that it's taken. Even Bihar is, taking, is second in the commercial and first in retail. So there must be something in Bihar that is allowing, the average micro entrepreneur in Bihar compared to the average per capita income of Bihar, which is among the lowest in the country, to take a fairly large loan and for lenders to be confident about lending in UP and in Bihar. And of course, that is also reflected in microfinance data where Bihar is doing very well. Goa and Sikkim, which are the most prosperous states, seem to have very few loans on an average. That if you take their per capita income, which is among the highest in the country, their average loan is very less. And therefore, it probably means that they don't have much of a entrepreneurial culture, that people are scared to take loans at small businesses. They're not growing into large. And therefore, I believe that these two states could do much more. Karnataka, I think, has a lower ratio of loans, the average size of loan to the per capita income. And again, that answer is that Karnataka could do more. But as expected, Gujarat, Maharashtra, Tamil Nadu, and even Delhi, their average loan size is broadly around 2.5 times the size of their per capita income, which probably is a good benchmark to say that if in a state, if your average loan size is 2.5 times your average per capita, you're probably as per the national average. And therefore, as I said, UP and Bihar are astoundingly larger businesses. And the northeastern states, as I said, sadly, not only have low per capita income, their ratios of average loan size to their per capita income is also very low, which again to me is a little sad and shows that despite all the effort being done to support the Northeast, the culture of entrepreneurship and the culture of starting a business and growing a business and taking a risk, which is all entrepreneurship is all about, is much more could be done there. Then we come to the last, the most important part, which is the repayment. It's all easy to give a loan, but how do you collect it back? And thanks to this being a credit information company, Equifax, they have very detailed data. Loans overdue by 30 days, 60 days, 90 days, 180 days, and even higher. And you can track this in extremely detail. But for the purpose of this report, I've picked 180 days. That all loans which are 180 days past due in their repayment, or as we say, portfolio at risk in the microfinance world. And across commercial plus retail business loans in India, 6.7% of the total number of loans were overdue by 180 days. And this is probably not a very good figure, especially when you compare with microfinance, where the loans are much smaller, but the overdue rates are also much less. And if you take by value, it is 5.8%. So there's not much difference by volume and by value. And therefore, in one sense, these loans are really risky. If 6% or 6.5% of loans are overdue by 180 days, and 180 days is a very good marker, because at that time you start provisioning, and anyone who's overdue by that is fairly unlikely to pay it back. Up to 30 days and 60 days, there may be temporary liquidity shocks or natural disasters. And again, the smallest loans have the highest number of defaults at 8.6%, whereas the biggest loans are only 3%. So that's also a question about, if you have a larger loan, then probably you have more at stake as a business, and you have more capability, and you're more resilient. Therefore, your default rates are less. But a small size loan, the really small one up to 3 lakhs, is much higher. And again, if you compare 3 lakhs to 36,000, it is a little surprising that the default rate is so high in the smallest size loans. And this, the ratio of this, in the report, when you read, you will not only see the national averages, but you will also see the state-by-state default rates, which is, again, I think, an unprecedented first for any report to look at how was businesses in each state, not only the loans that they're taking and the size of the loan compared to the per capita income, but also their default rate. And in all of this, of course, I've stayed with 180 days. So this challenge of repayment is something that I think is a big challenge we need to be looking at. Then I will come to who are the best in collections. And surprisingly, it was NBFCs. And the NBFCs, and here I'm only staying with commercial loans, their average loan which is defaulted, which is overdue by 180 days, is only 53% of their average loan size. But public sector banks, their average default rate is more than the average size of private banks or NBFCs. But RRBs are really in a bad shape because 13% by number and 14.5% by value of the loans are overdue. So I think their credit culture is really bad, and it may require a major rethink of why we need RRBs. To me, surprisingly, that SFBs, who are very new and who should know their borrowers, have 10% of their number of retail business loans, and these are only retail, are overdue. But their average overdue loan is very small at 51%. So if you look across the country, in urban areas, it's 6% overdue, and semi-urban is 7.7. But and therefore, in rural areas, it is, of course, a large number of loans are due. But it's surprisingly that in rural areas, the value of loans as a percentage of the loan outstanding is very low, which somewhere brings back to the correlation in microfinance, that the microfinance borrower is more willing to repay back. And in even rural areas, while the number of loans are overdue, but those who can are paying it back. And as I said, you look at the stress levels of loans. So northeastern states that have the highest, much higher defaults. And in particular, Assam was the most shocking for me because 18% of individual business loans are overdue. And in Arunachal, which is much smaller, it is 19%. So really, the northeastern states need to, promote the culture of repaying loans. Otherwise, there will be political pressure. Assam has just introduced a microfinance bill, and that will boil over. And in Maharashtra also, I was surprised to see that 13.5% of their commercial loans were total loans were outstanding, and the average outstanding is also so high. It's 2.5 times the size of the average loan. So that is a surprising fact that I got from this data. That Assam in particular, and I would like to highlight that apparently you take loans in Assam, you don't bother to repay it back with 18% of loans. And in Maharashtra, which is otherwise a fairly large, it is the commercial hub of the country, such loans are outstanding. So what is it about Maharashtra that is causing such distress to borrowers? So this is the sort of conclusion that I would take, and which repeats the points that Radhika said, that this is the first of a series and it will document. This is based on 31st March data. Next year's report will have more. And we need to do much more for policy. State governments and Niti Aayog, RBI, others need to start understanding how micro entrepreneurs are doing state by state, not just at national level, their borrowings and repayment. And we need more support. We need NESL as a system of authenticating loans. We need more accurate reporting. It's not Equifax's fault because Equifax is a collector of data, but there was a lot of other unknown category. There was not enough accurate. And we need to see how the entry of more SFBs and NBFCs will make it easier to lend and to know how much to lend. So this is the conclusion of this first year's report. Thank you very much. And I will now go back and stop sharing my screen, and we can go back to the... Thank you.
Thank you so much, Harsh. firstly for putting this report together, and also for joining us today for sharing the highlights of and the key findings of this report. And as you said, there are quite a few nuances that in the limitation of data for a particular year. I think you've put together quite a few cuts and details. So thanks for that. And moving on to Mr. Nanaya, I'd like to invite Mr. Nanaya now to share his perspectives with the audience, please.
Thank you, Radhika. I hope by the time we get the presentation up. Good morning, everyone, and respected members of the speaking panel, Shri Srivastava and Shri Mainiji. And we are very, very delighted to partner with Access to bring this report on state of micro enterprise financing 2020. As Radhika and Harsh mentioned, the data is as on March 2020, and obviously a lot of things have happened, post March 2020 in terms of the way the markets have moved due to COVID impact and due to the lockdown. So I'll cover a little bit about how the direction has been on the micro enterprise point of view from a loan disbursal standpoint post the March 2020. So just to give you all a flavor as to what the trends are. So moving on to the next slide, this is broadly what I propose to cover in the next about 10 minutes or so, in terms of giving a little bit of flavor on how the loan disbursement trends has been vis-a-vis of the GDP, and what the business loan trends are and the commercial loan trends are. And as Harsh mentioned, the definitions of business and commercial stays inconsistent with the report that has been brought out in partnership with Access. We have looked at sub 20 lakhs as a loan amount, and the business loan is the loan accounts which are reported under the retail category, and the commercial loans are the loan accounts which are reported under the commercial category. So which means micro enterprises, SMEs who borrow, and then that gets reported into commercial bureau. This is more from a bureau parlance standpoint. The business loans are borrowed by individuals but used for the business purposes, gets reported onto the retail. So we've tried to bring about both to give a broader perspective of the micro enterprises and the micro loans, which is, I think, is very, very critical for the growth of economy and for a quicker recovery. I think there has been a lot of physical stimulus programs by Government of India to enable access to credit for micro enterprises in the country, and then some of the impacts of that you will see in the subsequent slides as to how did that impact the disbursements in the country as we look through a little bit more data. And also, what does this all data speak in terms of what has changed, what's changing, and want to leave you all with a little bit of a perspective in terms of how does the future look. It's just from a very near-term standpoint, what has changed and what does the future look more from a lending perspective, more from a decisioning perspective, more from a technology perspective. How does it all look is what I'd like to cover a little bit in brief at the end of this presentation. So moving to the next slide, this is a bit of comparison with the GDP. So as all of you know, the GDP was on a growth path till the Q4 2020, that is ending March 2020. And come April, the pandemic hit, the lockdown came into play. And as all of you are aware, the GDP took an impact and it came down significantly. As you see on the graph on the left side, the dotted line is a line when the COVID impact and the lockdown started to hit the economy and the country and the world around. And that's where you see the GDP kind of declining. And I think the June end was the stoppage of the decline, right? If you see the graph, the June is where I think it starts to recover back. And you can see the graph moving up in the last quarter, with this July, August, and September quarter, the GDP is recovering. Now, if you look at the GDP in comparison to the business loan disbursals in the country, as the GDP, took a hit, the loan disbursements very naturally came down. Now, just a pointer here, even pre-COVID, there was a little bit of a weakness on the business loan disbursement. If you see the numbers between December 19 and March 20, you see the line is little declining on the right graph, and obviously it declined, at a much faster pace in the April, May, June quarter, and kind of starting to stabilize down June 2020 till September 2020. So the data that we have in this presentation is also still September 2020 as compared to the report, which ended in March 2020. So just to put this in perspective, while GDP looks like a V-shaped recovery, it's kind of pulling back, but the disbursements aren't pulling back in the same lines as the GDP growth. So that's a little bit of an imbalance that we see. But as you see in the subsequent slide, there's a little bit more color as to what exactly is recovering in line with GDP, what exactly is not recovering in line with GDP. So this is broadly how the disbursement looked like. So the good news here is that the downfall in the disbursement has stopped, but however, it has not recovered to the extent that GDP has recovered. So I think it's very important for this recovery. The credit offtake is very, very important for the recovery of economy. I think the bank credit is a very good indicator, and very, very critical for economic recovery, as all of you have heard, as all of you read in many different articles. That's very, very critical. Moving to the next slide, so next slide is about a little bit more detail in terms of how does the GDP versus the business loan disbursement look like. These are percentages of a growth or a degrowth. So as you see, September 19, obviously GDP was on a positive territory, was on a growth territory. March 20, GDP was on a positive territory. Whereas you see the red bar, which is showing downward. So even before the pandemic, the disbursement on the business loan side to the individuals for the purposes of business was showing a little bit of weakness. And obviously post March, in June 20, the GDP also, there is a degrowth in GDP. And you see the red bar, the disbursement also fell substantially. Now, come September, the GDP is recovering, so GDP is, this is a percentage improvement. What I must qualify here is the growth in GDP bar, the blue, is in reference to the the reduction or the degrowth that has happened. From a degrowth standpoint, it has grown further up. So this is a percentage comparison, not exactly a unit comparison. So you need to look at this graph from that point of view. But I think more importantly to look at the drop in the disbursement has kind of been arrested. So the drop is lesser as an end of September, while GDP is recovering. So I think the trends are starting to change with the economic recovery, with the GDP recovery. The disbursements are also starting to improve as we look at this chart very, 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 very carefully. So moving to the next slide on business loan trends, a little bit more cuts in terms of how the business loan trends look like. This is, as I said in the beginning, while the overall loan amount, that is a red line here. If you see the inflection point where GDP kind of started to recover, which is the June 2020, the red line indicates the value of disbursement. The blue line indicates the volume of disbursement, number of loans that has been approved. So it's a very interesting fact here, right? So while the value has kind of flattened out, did not really recover, but the number of loans that are disbursed have increased, have shown recovery. The good news or the positive news to take away here is the loans to the micro segment has improved, and it's in line with the economic recovery. It's in line with the GDP recovery. You see the graphs of the GDP and the loan accounts, the blue line, are fairly similar. So, which was broadly, the significant interventions happened by Government of India in terms of emergency credit line guarantee schemes and various other schemes, which is truly showing the impact in the number of small ticket loans that has been been given to MSMEs and micro enterprises, which is very, very critical. I think getting the micro enterprises back at work, back to business, I think was the intent, and it's very, very clearly visible from this graph. So moving to the next slide. This is, again, I wouldn't spend much time. This is a little bit more deep dive. I think Harsh talked about the distribution of loan between rural, semi-urban, and urban. And I think Harsh really, identified the semi-urban as the bigger portion of the loan disbursement. I think it's very, if you think of it, I think it's fairly natural because the cost of establishing a micro enterprises outside the large cities is comparatively cheaper than doing it in the large cities. And what it also helps is it gives them access to market, right? So being just outside the urban cities, which is semi-urban cities, gives them access to the urban cities, the markets, which are very, very important for micro enterprises. So as you see, the top left quadrant graph, this is about the loan accounts, number of loans that are being given out in rural, semi-urban, and urban. Again, V-shaped in rural, V-shaped in semi-urban. Urban looks a little flattish. So urban, disbursements have not been as good as the semi-urban and rural from a recovery standpoint. The story remains the same if you look at the top right graph in terms of the disbursements. So the disbursements, from a value standpoint, hasn't recovered significantly. Well, maybe the decline in the line is a little bit more flatter. So it shows that, the decline in disbursement from a value point of view is kind of arrested and starting to look better as we move towards September. And as we start to look at October, November, December figure, I would tend to believe that the values also will start to show an improvement. The bottom left quadrant is a very interesting trend. Again, all this data speaks to each other. That's the beauty of the data. That's the beauty of bureaus like us and in Equifax. When we look at the data, how data speaks in alignment, right? So if you look at the chart on the left side, we've specifically looked at 0 to 3 lakh loan disbursements. While overall evaluation, the analysis was 20 lakhs, we looked at 0 to 3 lakhs. The 0 to 3 lakhs as a part of the total disbursement in September or in December was about 70% of the total disbursement on the under 20 lakh bucket. Fast forward September, it's 90% of the total disbursement that have happened sub 20 lakhs. So again, reinforces the point that small ticket loans, MSME enterprise loans are seeing a good recovery, are seeing a greater focus, and obviously the fiscal stimulus announced by Government of India is starting to show results and translating into results from a disbursement standpoint as well. So which is a very, very positive sign for MSME. So the sub 3 lakhs is a 95% of the total disbursement. Moving quickly to the next slide, we'll talk a little bit about commercial loans. I'm not going to talk in great detail because very, very similar trends as you see. The blue line is number of accounts. The red line is the sanction amount. The blue line shows recovery back completely, V-shaped, whereas the red line with sanction amounts, the downfall is reduced, but the recovery is not as V as the number of accounts. Again, goes back to say that even on the commercial side of it, the small ticket loans are increasing, whereas the large ticket loans are a little flatter. That's why the total sanction amount is kind of remaining where it is. But the overall sanction amount, I think, looks fairly stronger as an end of June. I think that's positive. But I think critically, it is important to see as to how this is impacting the micro enterprises, which is the topic of the report that Access has brought out, and we're very delighted to partner with Access in bringing out this report. And as Radhika mentioned in the beginning, we are looking forward to continuing on this report year on year, so that we can build a lot more trends and analysis, and which could be a very great help for practitioners and regulators, and also to the credit institution, lending institution like banks and NBFCs. Moving to the next slide, again, very quick snapshot. This is a differentiation between micro and SMEs. This is MSME versus SME. Again, very interesting fact. If you look at the number of loans given to micro enterprises, is the blue line on the left chart. So the blue line shows a V recovery. The red line shows a stoppage of recovery, but a flat line. So which means, again, reinforces the point, micro enterprises are getting loans. Micro enterprise loan is, looking better, which is same on the right side as well, which is the amount comparison, which again shows a little bit of a good recovery for micro enterprises, which is the blue line. So again, every data point is reinforcing the point that the small ticket micro enterprise loans are showing the recovery. So moving to next slide quickly, in terms of what is the data speak, I think I covered in great detail. Along with the V-shaped recovery that is being observed on the GDP, the number of loan dispersed for micro enterprises are showing a similar trend. The business loan sanction, has recovered along with GDP, but sanction value has failed to keep pace with it. And post-lockdown, I think MSME loans are, the small ticket loans are on a raise, but there's a decline in the average sanction amount though. But I think it's a good recovery, a good stimulus, a good enabler for micro enterprises to revise and bounce back very, very quickly. I'll spend a minute on what does the future holds in the next slide. With that, I'll hand it over to Radhika and to keynote address by Mr. Maini. Moving to next slide, what's changing? Shift to digital. While digital was being talked about pre-pandemic, it's truly turning out to be, is it truly digital or not digital? So every lending institution in the country is looking at transforming their processes to truly digital end-to-end, straight through digital processes, right? So every stage of KYC, identification, verification, assessment, underwriting, all of that in completely digital form. And we play a significant role as a bureau. We've launched during this period a platform which enables lending institution to connect to the platform, do the entire end-to-end digital journey, and get a decision out. So you really don't have to build a digital backbone to do a digital lending. So we have a backbone which is readily cloud hosted, which can be utilized for these purposes. So I've lost the presentation, but I will talk about another 1 or 2 minutes in terms of changing consumer behavior. Radhika, can you hear me?
Yeah, they're I think putting it back on. Sorry.
That's no worries. I'm on the home run. I'll close it. Changing consumer behavior. The changing consumer behavior has changed. I think at least in the near term, what we see is borrow for essentials that are required, borrow for what is required from a immediate needs standpoint. That's a changing consumer behavior. Another point is about the credit decisioning. The whole credit decisioning process, I think, is taking a fresh look at it. When I say fresh look at it, is not only the current data of the borrower, but the historical data of the borrower, the 360-degree view of the borrower. I think these are critical elements of the credit decisioning. And we as an organization, we launched a score, which is a risk score, which takes into 7 years past data to build that longer term view to enable credit institutions, that banks and lending institutions, to make more informed decisions based on historical data of the borrower, and also plus provide a 360-degree view of the borrower, right? With the coming in of account aggregator, some of these are becoming a reality in terms of being able to bring both asset and liability information together to provide a 360-degree view of the borrower. So we as a bureau, we play an enabling role from a technology perspective, from a data perspective, from an analytics perspective to enable access to credit. And the lending outlook, I think, rural and semi-urban looks pretty strong. And urban, we're hoping that this quarter, I think it will start to see good recovery. And there is a correlation seen between the COVID cases and the loan disbursement. The higher the COVID cases, I think the lower loan disbursement is what we observe. But a little bit early days because lots of things are changing. But we are watching this very, very carefully. And with that, I'd like to thank Axis for this opportunity, and I'd like to thank Harsh for bringing together the report. I'm sure as much as we all have put in an effort, you all will enjoy reading it, and you will find it extremely useful from the insights that has been brought up by Harsh in this report. Thank you all very much.
Thank you, Mr.
Thank you. Thank you so much, Mr. Nanaya, for, of course, once again, for sharing the data for this report. But of course, your presentation, since that used more recent data, and in the context of pandemic, obviously, the insights are highly relevant. And from what you just shared, I think everybody will be encouraged from that data to see the improvement in loans post, between June and September. And then, of course, going forward, we will hope that trend actually holds up. So this is the kind of data actually will be very useful that we will probably be able to share in the next edition of this report. Thank you so much for that insightful presentation. And I would now request Mr. Meni to deliver the keynote address for this session, please.
Thanks, Radhika, and good morning. My special thanks to the organizers for inviting me to deliver this keynote address. Firstly, my congratulations to Access and Equifax on this very pioneering first-time report on the micro enterprises, which has brought out a lot of interesting insights on the behavior of the micro enterprises, particularly in this pandemic period. And, very nostalgically, I'm recalling that the term missing middle was actually coined by SIDBI about 1.5 decades back. And at that time, when we were dealing with some multilateral institutions, we had defined missing middle as loans beyond the microfinance limit, which was, I think, 50,000 up to 10 lakh rupees. That is how we defined it. And today also, the definition stands with perhaps the limit being raised to 20 lakhs, which is inflation linked in any case. My address may at points go slightly beyond micro enterprises, and I would be talking about MSMEs also in at certain points, perhaps. Let me start with the overall scenario of the micro and small enterprises sector. The MSME sector obviously is the key to the growth of the Indian economy. About 70 million MSMEs contribute to 1/3 of the country's GDP and 45% of the manufacturing output. These enterprises also provide employment to well over 11 crore Indians, besides substantial contribution to the exports of the country. The sector obviously is seeing currently is seeing a huge credit gap, which it always does, as elsewhere in the world also. Nowhere in the world has, I think, anyone addressed the conundrum of financing MSMEs absolutely thoroughly. And we are also, like the rest of the world, continuously trying to address that issue. According to a recent BizFund report, only 16% of the MSMEs in India receive formal credit, leaving more than about 80% of these companies either underfinanced or financed through informal sources. And as we are all aware, informal credit obviously ends up as being more expensive than debt, making it difficult for MSMEs to address the accumulated debt burden or grow beyond certain levels. The overall debt demand has been estimated at about 70 trillion Indian rupees, approximately $1 trillion. A major part, about 84% of this debt, is financed from informal sources. This is the opportunity which exists today for the formal sector institutions to actually tap. Within the formal sector, as Harsh also brought out, the scheduled commercial banks account for a major share of the debt supply to the MSME sector. And then there are the NBFCs, the state level institutions, and the regional rural banks, the small finance banks, etc. And of course, the financial institutions like NABARD and SIDBI, which are playing a major role in addressing the gap. The question now is, what out of the total gap is the addressable gap, really? And this is estimated to be about 26 trillion rupees, which the formal financial institutions could viably finance in the near term. And half of this gap approximately is on account of the manufacturing sector and half on account of the services sector. Coming basically, the lower level of bank penetration, propensity to fund the services sector which is normally fueled by its shorter working capital cycle, generally has resulted in a constricted flow to the manufacturing sector. And thus, when I come to my recommendations later on, some of the recommendations would be specifically as to how to increase the flow of credit to the manufacturing sector. In the pandemic situation, particularly, the MSME sector has been further hurt. COVID-19 has led to some of the major problems which the sector continues to face, accentuating some of the major problems which the sector continues to face. One, the impact on the earnings due to disruptions, demand-supply mismatch, closure of export markets or reduction in export markets, liquidity constraints, expenses continuing on fixed assets while the earnings have come down or totally stopped. Then the post-lockdown tie-ups with fresh clients, new clients not really happening, raw material sources drying up, marketing-related issues. A host of issues have arisen due to the pandemic, and simultaneously, a huge number of livelihoods have been impacted, especially for MSMEs and the informal sector workers. Millions of jobs perhaps have been lost, or there are people waiting, shelved to get back to their work. The impact obviously has been extremely adverse, and going forward, the road to recovery is time consuming, but I'm happy to see that the report has shown the positive signs towards this recovery in the micro enterprises. Some of the initiatives taken by the Government of India and the Reserve Bank of India for addressing the economic disruptions caused by COVID-19 crisis include the moratorium for principal and interest dues till 31st August 2020, introduction of the regulatory measures involving rescheduling of payments, easing of the working capital financing, and consequent asset classification and provisioning norms, providing assistance to the tune of 3 lakh crores under the Emergency Credit Loan Guarantee Scheme, which probably has been one of the greatest drivers of this recovery, which we were seeing in the earlier presentation by Mr. Nanaya and Harsh. Introduction of a resolution framework for COVID-19 related stress, and lastly, the liquidity related measures for various kinds of financial intermediaries provided by the Reserve Bank of India. Now, given the scenario which has come out and the report which was presented, I would just like to comment on 3 or 4 points in the report and the findings in particular. The default of 6 to 7% compared to was being compared to the microfinance sector. Harsh brought out that comparison. I do not think it's a fair comparison, because the microfinance sector also has a collateral in terms of the social collateral, the implicit guarantee of the other group members, which enhances the recovery to a large extent. While many of these enterprises effectively have no collateral worth the name, really, if you go to enforce the collateral security as a bank or as an NBFC, many of the loans are actually collateral free, which is why a 6 to 7% default, if we compare it probably to the corporate sector, may be a better yardstick. And there, I think it's not a very high cost to be paying for the development of this sector. It was also mentioned that the number of loans has shown the recovery while the value is lower, which is very, very obvious, because most of the loans were covered under the Emergency Credit Loan Guarantee Scheme, and only 20% of the loan amount was being outstanding amount was being sanctioned. So there would have been repayments. There's an so loan less the repayments, the outstanding, and 20% of that is what was guaranteed. And most of the institutions have taken cover under the guarantee scheme and sanctioned those loans basically. So therefore, it is quite obvious that the size of the loans would be lower, but the redeeming feature is the number of loans is increasing, and that is very important at this point of time, which means the measure has really, the measure which was put in place has really worked. There was a mention about the missing middle being in the 5 to 10 lakh loan space. I would think that given the revised definition of MSME, it would be desirable actually to look at it beyond that, really up to 20 lakh perhaps, because within that definition now is the scope for MSMEs to really keep growing without losing out on the incentives in the MSME space. I would like to come after these general remarks, I'd like to come to some very specific recommendations for the growth of the sector. And I do think that the report from this summit would be placed before the government. So I hope some of these suggestions find place there also. As we are all aware, there is already a well-developed infrastructure of institutions in the country catering to this sector, comprising DFIs like SIDBI and NABARD, which are playing a yeoman's pioneering role, the public sector banks, the private banks, the small finance banks, which are just about 5-year-old, and therefore that contribution of 1% perhaps needs to be looked at in that context. The NBFCs and certain state-level institutions like the SFCs and the SIDCs serving the sector. A huge network of commercial bank branches, over 150,000, coupled with about 6 lakh branchless outlets in villages, provide a substantial reach today for not only for the banks as such, but for any of the financial institutions willing to leverage this network. And this, on the back of the JAM Trinity, Jan Dhan, Aadhaar and Mobile, provides us the perfect lever to really start serving the sector in a very big way. We need to leverage the existing infrastructure and strengths of all the players, all the existing players, and particularly the NBFCs to ensure the last mile connectivity. The revised definition also ensures the seamless growth of the units without losing the benefits available to them, which was one of the problems earlier and led to a lot of horizontal growth and not vertical growth amongst the units. So my first definition, my first recommendation pertains to the manufacturing clusters to a large extent and the informal clusters. There are about 400 odd manufacturing clusters, formal manufacturing clusters in the country, and more than perhaps 5,000 informal clusters across the country. What needs to be done is a comprehensive competitiveness study be carried out on the major clusters and some of the major informal clusters also to identify the gaps in the financing and other requirements of those sectors. A separate body can be set up really to promote competitiveness of clusters, and once we have identified these gaps, we address those gaps and we make our clusters much more competitive. And this reminds me of the seminal work by Michael Porter on the competitive advantage of nations, which bears out the underlying theme of continuously working on improving the competitiveness of clusters. And this is one of the easiest ways in which we could address all the issues relating to MSMEs in those clusters. And I think if we are able to address the cluster issue, we would have addressed about 80 to 90% of the problems of the MSME sector. Again, land in the clusters or the industrial estates which is made available to micro and small enterprises comes at a very, very high cost. It's very expensive. And there's a need to promote industrial estates with sheds purely on rental basis. This would also obviate the locked up productive assets. When a unit becomes an NPA, those assets remain locked up for ages before the loan amount is resolved or the asset is sold. And therefore, this would actually also offset that problem and probably lead to more cash flow based lending because the collateral of the land would not be available, and there's a desirable need to move towards cash flow based lending to the micro and small enterprise. The third recommendation is really for the industrial associations to be very, very substantially empowered, perhaps on the lines of the associations in some of the developed countries, more particularly the BMOs in Germany, who carry out a host of activities for their members, really. And we have a good model even in India. The Faridabad Small Industries Association set up what is called the I am MSME of India, an association, and where they act also as a financial intermediary, providing a first level check on all their members to banks and institutions who want to lend to them. They aggregate the demand for common raw materials, insurance, etc. A lot of such common services are provided by these associations. And therefore, if we can empower our associations, I think a lot of issues relating to the sector could be resolved. The next recommendation would be, to raise the collateral-free limit under the Mudra loans from 10 lakhs to 20 lakh rupees, for the very simple reason that this limit came up in 2015 when Mudra was set up. I remember I was the person who had actually written the part of the mandate for Mudra before I retired in 2015, and that, at that time, keeping in line the missing middle also, we had kept it at 10 lakhs. But today, given the revised definition of MSME, the need to look at this limit being enhanced to 20 lakhs is very much there. The 59-minute loan portal, the PSB loan portal, has been a great initiative. And what Mr. Nanaya mentioned about digitalization, I think this portal really reflects those features. It is featured with a completely data-driven process backed by algorithms. And those algorithms run on about 1,000 odd data points and give approval to an MSE for loans up to 1 crore within 59 minutes only. It has been considered as one of the most comprehensive processes globally also, and therefore making this as a kind of a one-stop shop for the micro enterprises needs, loan needs, I think is something which needs to be looked at. Of course, all the other NBFCs, etc., have their own individual models, but there would be a need to, collaborate and perhaps leverage both the strengths of the NBFCs, the small finance banks, the commercial banks, and the PSB loan portal to give the best to the micro enterprises. The couple of issues in regard to equity, quasi-equity support, basically PM has recently launched the 1,000 crore seed fund for startup sectors. The startup sector in India is something which is doing an amazing job today and needs a great support. So right from financing proof of concept to giving them very, very small loans or grants is what is conceived under this startup fund of 1,000. Funding proof of concept is something which would give a lot of, impetus to our startup movement. The receivables issue is something which the sector has been plagued with over the years. Government has taken initiatives to ensure that the PSUs and the government departments enroll on the TREDS platform and make their payments in time and bring in a lot of transparency in their payments. But it is absolutely necessary that all large corporates and all micro enterprises be gradually enrolled on TREDS. And this is where the role of credit bureaus etc. would also become a very important role to help them access this platform. Some of the policy support measures really would include the targeting of the underserved states, and within the underserved states, the underpenetrated urban, semi-urban and rural areas, which Harsh has very beautifully brought out in the report, the mention of which are the areas. A lot of them have been clearly demarcated also. And the stark contrast is very, very visible between those areas and the served states in particular. The GEMS platform promoted by Government of India, that is the government e-marketplace, is indeed a great initiative and needs to be replicated by perhaps more organizations in the private sector to provide such marketplaces to more and more smaller enterprises also, and simultaneously the need to launch virtual trade fairs and exhibitions, given the fact that physical trade fairs is not going to be a reality in the near term, at least for quite some time, and the need to move to e-trade fairs and exhibitions obviously is something which the private sector could be promoting. Lastly, while CGT-MSE and NCGT support to the MSCs has been one of the major initiatives in promoting collateral-free lending, these organizations need to be further capitalized so that they can continue to increase their coverage of collateral-free lending to the micro and small enterprises. I think there are many more recommendations. I know there's a paucity of time. Radhika is already looking at the watch probably. And I would like to end by saying that there is enough surplus liquidity in the system today. Last night also there was a mention of about, I think, 6 trillion rupees surplus liquidity in the system when in the fireside chat between Tamal Bandyopadhyay and in the fireside chat and Aditya Puri. And I feel that appropriate support at the policy level along with this surplus liquidity can really galvanize the productive utilization of the liquidity, particularly by promoting the micro and small enterprises sector. The inherent Indian spirit of entrepreneurship is very much alive, and if we galvanize this liquidity, provide the right policy support, we could actualize the dream of Make in India and Atmanirbhar Bharat. Thank you. With those last words, I would end here. Stop there. Thank you.
Thank you so much, sir, for